Since my last portfolio update, I've invested over $6.6 thousand in new stocks. This was split among 3 companies that I deem to be of extremely high quality and trading at a fair price. Throughout this video, I'll explain the logic behind these transactions, share some Warren Buffett wisdom, and of course, update you all on the overall progress of my long-term dividend stock portfolio. My name is Zach, and you should leave a like and subscribe to the channel if you enjoyed the video. Before we start the analysis, I'd like to let you know that you can join a community Discord server and gain access to a spreadsheet showing my full portfolio if you support the channel over on Patreon. Link in the description. With that said, let's dive into the numbers. Since May 2020, I've gone from $32,929 to $61,961 invested. My current dividend yield on cost is 4.24%, and my compounded yield, which takes into effect reinvested dividends, is 4.41%. My portfolio's dividend yield has decreased significantly since many of my newer purchases have a lower starting dividend yield. This is part of my transition to a focus on quality and potential for long-term dividend growth. The differential between dividend yield and compounded dividend yield increased 0.18%. This stat acts as a measurement of the snowball effect from dividend reinvestment. In this chart, you can see how the value of my dividend portfolio has changed over time. My current value is $78,907.77. This has continued to rise with the market, and it's performed quite well in 2021. Many of my more contrarian 2020 investments in energy stocks and REITs are now paying off. However, value is volatile, and the main goal of this portfolio is to build a source of growing dividend income for the long term. In this next chart, you can see my earned dividends to date. In May, I earned $193.71 in dividend income. Notable payments include $116.78 from AT&T and $46.97 from EPD. Based on that, this brings my 3-month rolling average of dividend income to $214.61. In June, I'm expecting to have my largest month of dividends so far, led by ExxonMobil. Here you can see my cost allocation by sector. Consumer defensive is my largest at 24.6%, followed by communications services at 22.1%, technology at 15.1%, and energy at 15%. Technology has grown to be my 3rd largest sector, which should tease some of my recent investments. Alright, now let's get to the topic of the day, my new buys. I purchased 18 shares of Disney at an average cost of $173.16, 17 shares of Apple at an average cost of $124.15, and 6 shares of Microsoft at an average cost of $242. In total, this amounted to $6,679.39. If you follow the channel, then you know I hold these companies in high regard and try to dollar cost average into the stocks every month. However, in May, I loaded up far more than my usual few shares. Before I fully explain my logic for this move, I'd like to share some wisdom from my favorite investor, Warren Buffett. He's been quoted to say, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In the following clip, Buffett adds to this idea by explaining when's the best time to buy a great company.
In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but it's true, actually.
Close enough.
Yeah, close enough, right? So you can get some accidents like that. But that's a lot to count on. And if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. It's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and the price looks a little high maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way.
So how do Warren's arguments connect to my recent purchases? Well, I've identified Apple, Microsoft, and Disney as some of the highest quality companies over the coming decades. I made stock reviews that fully lay out my investment thesis. Each company has an incredibly wide economic moat and strong brand. They all have reliable sources of income and are moving parts of their business towards the subscription model. They have high margins and pricing power against competition. Finally, each business is highly scalable. Disney, as an entertainment company, can replicate its content at no incremental cost. This is the same with the software-based offerings of Microsoft and Apple. These reasons briefly explain why I've been dollar cost averaging into Disney, Apple, and Microsoft. So why did I start buying heavier? As Warren says, unless you find the prices of a great company really offensive, it's better just to own them. I agree. In early May, all three of these companies reached what I thought was a relatively fair price. Both Apple and Microsoft had blowout earnings, which brought their forward PEs to lower levels compared to their sector peers. The best part was that the stock slightly fell on the news. I was buying Apple at a forward PE of 24. This is the same multiple or cheaper than companies like Coca-Cola, PepsiCo, Procter & Gamble, Colgate, Clorox, etc. It's so obvious that Apple will be able to grow their earnings at a faster rate than these companies while being just as defensive, if not more. It's a similar story with Microsoft, but I think Apple is actually a better value at the moment. With Disney, the stock fell on the release of Q2 earnings. They announced Disney Plus subscribers had slower growth at 103.6 million subscribers, which was below the estimates of some analysts. However, Disney said it was in line with their expectations and doesn't change their future projections at all.
Well, our outlook continues to be 230 to 260 million households by the end of 24, consistent with the guidance that we gave last December. We've added 30 million new households to Disney Plus just in the first 6 months of the year. So we're extremely bullish. And in fact, this quarter's numbers were exactly as we projected internally. So no disappointment here. I think if you want to look at the actual rate of net adds, we've actually added more in the last month than we have in the prior 2 months in terms of households. So we see our net increases increasing. We hit the number we project, and we're looking towards a nice long run here all the way to 2024 to hit the same numbers that we projected back in December.
So I'm not worried in the slightest about Disney Plus. Also, all of Disney's business will finally be returning to normal by the end of the year. The parks will all eventually be at full capacity, and many movies will be returning to theaters as well. CEO Bob Chapek said that demand for Disney World is already exceeding 2019 levels, so we are soon approaching the point when Disney's business will be completely back to normal with the growing monster of Disney Plus added on top. Of course, I'd love it if all these stocks got cheaper. Then I would increase my buying even more. I'll likely continue to add to these positions unless they become offensively priced. Now I know we focus on dividend investing here, so many of you may not buy these stocks because of their current low dividend payout. Heck, Disney currently has suspended their dividend until operations return to normal. So if you're trying to live off dividends right now, this is not the place to look. However, my investing strategy is looking decades into the future. I'm not trying to live off dividends anytime soon, and instead reinvest that income to increase the compounding effect. If you have a long time horizon, it's not all about the current dividend. It's much better to focus on the future earning power of the business. Disney, Apple, and Microsoft will be able to pay a growing dividend for decades to come. Thank you for watching Dividend Data. I'd greatly appreciate it if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Also, you can follow me on Instagram at Dividend Data. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.